Hey, good morning everybody, it's Brian. Today is the 17th of December, Tuesday, and just here for my morning update. I'm a little bit late. Normally I like to have these done by about 8 o'clock Central Time, but since I'm not actively trading, I spend my mornings doing some other things and a little bit late getting to the actual updates. But let's go ahead and jump in. We'll talk about a few things again. Full disclosure, I'm not trading, I'm not physically entering the market until after the new year. I am still looking at the market, and I've got some information to share with you about the eminis. We'll talk a bit more about what's happening in the forex markets, just some very, very basic strategies. Again, my personal philosophy, and I preach it over and over and over, is that I like to keep it simple. The simple stuff works. I'm not saying that you can't load up with indicators and go to town and have amazing results using other very indicator intensive systems. I'm saying that it's hard for a trader, especially a new trader, to be consistent when you do that, because the more stuff you add to your screens, the more, and I hate to use the word analysis paralysis because I think it's overused, but it's true, the more analysis paralysis you're going to experience. When you've got a lot of indicators on your screen, it becomes tough to sort through that. Mentally, because you're not finding as many setups typically, and it becomes tough to stick to that process and execute the same way every time. When you've got a very simple process, you're more apt to repeat it, right? So anyway, let's talk about the eminis. We'll pull this up over here. Yesterday we talked about 3200 when we came in yesterday. We're hanging out around here, and we talked about 3200 as being a major area. It's a whole number, and when you've got a whole number, it can be a spot for some indecision in the marketplace. Typically, doesn't happen always. Again, there are no definitives in the marketplace. There's nothing that always happens the same way every single time. But typically, when you get around whole numbers, you'll see price stop, stall, maybe make a quick retracement. So yesterday we said, hey, 3200. Even though we're in an uptrend, and we're still in an upward trend, if we do anything that's a short against the E-minis, we're going against the current trend. I like in a current trend, better to play pullbacks, right? I do think, and I keep saying this, eventually when the market turns, it's going to fall very fast and hard. But until that happens, we have to trade with the trend. Not to say you can't take some counter trend trades, but you're better off in the long term trading with that trend. So yesterday we talked about if you're a scalper looking at 3200 for some quick pullbacks and maybe picking up a couple of quick points on scalp trades. And we can see yesterday it came to 3200 and it hung around right here, hung around for quite a few hours on 3200 and then eventually broke down. Nice trade with just a couple of points of risk. You could have taken a couple of points of risk on this and had some, at least 1-to-1, if not almost 2-to-1 returns on your risk. So it played off of 3200 a couple of times this morning, leading up to the U.S. start of the active session. We saw price push beyond 3200. And it pulled back to this 3196, 3195 area, and looks like it's going north from here, but who knows? I personally, if I were in the market, I would continue to sell it off of 3200 until it broke and took me out for a loss. Whenever you're playing a support or resistance trade, in this case resistance, right? Anytime you're playing with a support resistance type strategy, you're eventually going to be wrong, and we have to accept that. That's part of being in the market. We're going to be wrong. Our job is to have very limited risk, so that when something does move against us, we're able to get out of it quickly, and then make a decision of whether we want to re-enter in another direction, or wait and see if we can re-enter again in that same direction previously. It all comes down to whatever your plan is. For me, I've talked about my plan is to look at the market on an H4, and then I scroll down to a 30-minute. So I use the 4-hour to identify potential support or resistance areas. Then I scroll down to a 30-minute and I watch for how the market's reacting around those areas on that shorter time frame, and then I make my trade entries off of that 30-minute time period. So, but you know, it's one of those things I post, and if you go back to the YouTube channel or the Facebook channel, you'll see the updates, and you'll see I post the trades that I take in here so that you know what I'm taking, when I'm taking it, what the outcome is. I have a fairly high win rate off of that, but you can never get cocky about that. When you start to get cocky off of win rate is when we typically start risking too much, and that can become an issue down the road. That's a very fast way to go down that road to ruin, right? When we start getting cocky and we say, oh, I've got this higher win rate, I'm going to start risking more. And then if you're wrong, not if, when, because it's inevitable, when you're playing a support or resistance or any trading strategy for that matter, you're going to have losing trades. It's just a fact of trading. You're going to be wrong about that direction at some point, and you might be wrong about that direction multiple times in a row. So if you start risking too much because you've gotten cocky about the win rate that you've got, you can start going down that road to ruin very quickly, and that's where things start to fall apart. We start to deviate from our trading plan, we start to double up on trades, we start to double up on risk, so on and so forth, and that's why you get that parabolic curve when it comes to accounts being blown out. Once they reach a certain point, it's a very fast road down to the bottom. Anyway, that's a tangent. Don't want to get off on that, but we talked a little bit about eminis yesterday. Looking at 3,200, I would still be watching that today, and I will still watch it today. Obviously, I'm not trading. I don't have any live money on the line in the marketplace. But you know, for me, if I was live in the market today, I would continue to watch 3,200, and I would continue to fade off of that key level right there, off of that 3,200 level until it's broken. And we see things close above it and continue to move. I wouldn't be inclined to buy, even though it is with the trend is up. For me, in order to buy, I'd prefer to see it retrace down to this 3182, 3183 area, and then buy off of that level or slightly lower, even 3180, in order to trade with that trend. But short term, from a scalper style, I would continue to scalp off of 3,200. But again, I'm not in the market, so I'm not doing that presently. From a crypto standpoint, we talked a little bit yesterday about how we get into these channels and looking at potential breakouts on volatile instruments. I really like breakout strategies, especially like Bitcoin, Ethereum, where you get into these areas where we'll trade in a channel for an extended period. And logic says it's going to move. We don't know what direction, we don't know when, but when you have a volatile instrument that gets into a very tight channel for an extended period, it is going to break out of that channel. Now, the fallacy there is people want to predict which way it's going to go and think they can predict which way it's going to go with any level of accuracy. That's where we have to step back and be aware of what our mindset is doing. Are we making a trading decision trying to be predictive, or are we making a trading decision based on odds and probabilities? Knowing that something's going to break out, that's playing the odds. If you've got something that typically moves in a fairly wide range and it's into a very consolidated period, it's going to leave that consolidation. It's going to leave that consolidated area. We just don't know what direction, and we don't know when. So, playing breakouts is a great way to go. And we talked about that yesterday here on Bitcoin. We talked about looking at sell areas down below that 70.40. We talked about buy areas, above 71.60. It broke down and has now moved this morning quite a bit. Same with Ethereum. Yesterday we were looking here in this range. It consolidated, and it just stayed in a very consolidated area, and now has just broken down with a fever pitch. So a lot of opportunity there when you get these fairly volatile instruments that get into ranges like this. Now, again, knowing you don't know which way it's going to go, but you could trade with the trend. Again, if you're looking at the current trend on any of these, that the current trend has been pushing down. You know, if we look back over time, Ethereum's been pushing down, Bitcoin's been pushing down. You could just simply say, I'm looking for a break lower, and if it breaks, you know, 140, talking obviously historically, right? If it breaks 140, then I simply want to settle. I'm not and don't look at any upward breaks. I think that's a little bit short-sighted when you're playing a breakout, again, because you don't know which way it's going to go. It could go either direction. But obviously, you know, trading with the trend historically is the best the best idea there. You know, so until you have confirmation that that trend has changed, you know, keep selling it in a downtrend, keep buying it in an uptrend. So anyway, there we have that for now. As far as currencies go, same exact process. You know, as we're looking at here, as we're looking at over here, right? Same exact process. You know, see if I can flip that. I don't know if I can. Well, anyway, I don't know what I've just done here. Somehow I've gotten multiple things up, and I seem to be covering up my my screen area. How do I make it stop? Make it stop. There we go. Anyway, totally lost my train of thought. Talking about breakouts. Oh, forex. Same exact process as we're looking at over here with cryptocurrencies. A great strategy in forex is a breakout strategy, and again, just finding currencies that have a fairly volatile pairing. So, you know, the pound versus the yen, the euro versus the yen. You know, there's a few different cross pairs that have high ranges. Look for those currencies that typically have fairly high ranges, and look for opportunities for breakouts. I do still owe you the breakout strategy and the indicator. I did not have a chance to get to that at the end of the week last week. I do have time this week. It's on my agenda for today to record an actual training module on trading a breakout strategy. So I'm going to get that done, get that out to you, and I'll put the MT4 EA online for you as well. So anyway, that's it for now. I just wanted to kind of recap where we are, where we were, where things are right now, the things I would be looking at if I was live in the market. And I think we've done that. So I'm going to go ahead and let you guys go, get on with your day, and hopefully you got a little bit of information out of these tidbits. So I'll talk to you later. If you have anything, you've come across any information that I've shared today or any other days, by the way, feel free to share it with your friends. Take the video, click share, or invite them to the page over on Facebook or on YouTube, and make sure they're getting this information. Because again, I do this training for free every morning so that you can see what I'm trading, how I'm trading it, and you can see that using a very basic strategy can be successful as long as you're consistent in that application. All right, so anyway, that's it for now. Have a great day. We'll talk to you soon.